No, the curve is important, and the curve has reacted. I think it surprised many investors as the Fed started to cut rates. Typically, yields come down, but the curve steepened and yields went up as the Fed started to cut rates. We think at this cycle, if the Fed were to pause, you might see a little bit of a rally, but the underlying story for 10 years is really will be not so much payrolls, but what do the inflation numbers look like next week? Inflation's critical, and that really is the cornerstone to pretty much everything in fixed income these days. And the expectation is that inflation is going to continue to decelerate, and decelerate at a fairly slow pace, but still decelerate. If that is stalling out or showing signs of picking up, well, then the Fed's really in a bind, because perhaps payrolls are pretty healthy and inflation is sort of now starting to show some upward signs of momentum, and we have new policy changes coming from the new administration, which on balance could be inflationary. So the ball of string starts to unravel a bit, and then the Fed has to decide how I think they would fall back into a much more patient strategy. And we think that what's happening over the last couple of days, this week, certainly with Powell's comments, they're creating optionality for themselves. They're very data dependent. And the reality is forward guidance is not really a thing right now, but they, like everyone else, is very data dependent. And not only are they data dependent, but they're becoming more and more near-term data dependent. Fed policy is for an impact that's really many months out, many quarters out, and we're looking at today's payroll report.
Extraordinary number of variables, not least of all the Scott Bessent factor at Treasury. George, Mandy has a question.
Yeah, sure.
Yeah, absolutely. I think, optionality is probably the most important tool in the Fed's toolbox, right? Of any central banker's toolbox. But to your point about inflation being the cornerstone here, I mean, earlier on this year, George, all the central banks were kind of patting themselves on the back, saying all of our heavy lifting has made sure that inflation is no longer public enemy number one. But when you talk about the incoming administration's potential policies, things like lower taxes and higher tariffs, wouldn't that be inflationary? And if so, how much so? Like, we're not going to go surely back to the big bad old days of super high inflation post-COVID, but surely it might be high enough to stop the Fed from cutting.
That's a fantastic question. I think you really hit the nail on the head, and it's the challenge is not so much sort of whether or not inflation is going to be sort of up or down. It's magnitude that matters, and we think that on balance we've been through a regime shift, and the regime shift was an environment for almost 20 years where inflation, the ceiling on inflation was 2%. We think we're in a new regime where the floor on inflation will be 2%. That's a dramatic shift in sort of underlying economic activity. Obviously, as you mentioned, there's some policy, perhaps accelerators that get attached to that. And then very, very importantly is how do central banks respond to that? That means they're kind of on the defensive, if you will, and it's critically important, absolutely important, that central banks preserve their inflation-fighting credentials. They don't have the tailwind of strong disinflation. There's sort of mild reinflation that central banks need to contend with. It's all very manageable, and you're absolutely right. Orders of magnitude matter. This is not an environment where we don't believe this is an environment where inflation runs away from us, but it is an environment where inflation will be persistently above target. The Fed will need to contend with that, and as you mentioned, the sort of the fiscal impulse, not just in the U.S., but seemingly around the world, could be inflationary on balance. That all means that rates stay higher for a little bit longer, curves should steepen a bit, and that perhaps long end yields are just simply too low. It doesn't mean the bond vigilantes have to come out full force, but it does mean that long end yields are a bit underpriced in this kind of environment.